All right, let's get right into it. The stock market has been on an absolutely incredible run for years now. And, it's got everyone asking the exact same question. What in the world is 2026 going to look like? Are we talking about another boom year, or is a bust right around the corner? Let's figure this out.
This quote right here from Andrew Sliman at Morgan Stanley, it just hits the nail on the head. It perfectly captures the tension we're all feeling. Late cycle? Yes. End of cycle? No. He's basically saying, yeah, we're in the later innings of this thing, but hey, the game's not over yet. And that single idea, that's the fault line, the big dividing line for pretty much all of Wall Street's 2026 predictions.
And that really brings us right to the heart of the matter, doesn't it? I mean, we've had 3 stellar, unbelievable years of returns. Statistically, the odds of getting a 4th great year in a row, they're not great. So, the big question is, can this bull market just keep defying gravity and charging ahead? Let's see what the pros are saying.
Okay, so to really wrap our heads around the 2026 outlook, we've got to understand this huge debate that's happening right now. It's basically a clash between two powerful and almost completely opposite visions for what's coming next.
So in one corner, you've got the Super Bowls, guys like Ed Yardeni, who are convinced we're living through a new roaring 2020s. But then, in the other corner, you have the bears, like Michael Lebois. He's looking at the exact same data and just shaking his head, warning that valuations are extremely stretched. I mean, the gap between what these two camps are expecting, it is absolutely massive.
And right here, this is the hard number that gives the bears' argument its teeth. The market's forward PE ratio is sitting at 22.7. Now, to put that in perspective, the average over the last 10 years is 18.6. So we're talking a significant premium. This isn't just some gut feeling. It's a cold, hard fact that shows stocks are expensive. They're going to have to deliver some serious growth to justify these kinds of prices. And all this talk about growth, well, it leads us directly to the single biggest story in the market. It's the one thing that's fueling both the incredible optimism and the deep-seated fears. You know what I'm talking about. Artificial intelligence. It really is a double-edged sword. So check out the bullish case for AI, which Ed Yardeni lays out really well. He sees it as a 2-step process. Step 1, we've already been living it, right? It's all about the AI producers, the big 7 tech giants building the tech. Their stocks have just gone to the moon. But step 2, that's where things could get really interesting. That's when the other 493 companies in the S&P 500 become the AI users. They start adopting this tech, boosting their own productivity, their own profits. And that's the theory for how this rally stops being a tech story and becomes a whole market story.
But just when we're starting to feel good about that rosy picture, Morgan Stanley's hedge fund desk comes in and throws a bucket of cold water on the whole thing. They're seeing signs of excess and are warning that the market might be ripe for some creative destruction. They're asking a really important question. How long are investors going to keep throwing money at the promise of future AI revenue before they start demanding to see actual, real profits? Because when hype starts driving investment instead of earnings, well, that's a classic warning sign of a bubble.
And this term, creative destruction, it's so important to understand. It's basically the engine of capitalism, right? It's the process where new, groundbreaking innovations come along and just completely disrupt and sometimes destroy the established leaders. So in this AI arms race, it means the companies that are on top today, there's absolutely no guarantee they'll be the winners tomorrow. Some new, scrappy, more efficient player could come out of nowhere and change the entire game. Okay, let's shift gears now to the next huge piece of the puzzle, inflation and the Federal Reserve. Because look, no matter how powerful this whole AI story is, at the end of the day, the macroeconomic climate that the Fed creates, that's going to be absolutely crucial for the markets in 2026. And what's really interesting here is that it seems like both the bulls and the bears are kind of on the same page. They think inflation is going to keep cooling off. The bulls will point to AI making everything more productive and keeping costs down. The bears? Well, they just see a slow grind down. And one huge factor that everyone's got their eyes on is shelter costs. That's a massive component of inflation, and it's finally expected to start falling. So this all leads to the big multi-trillion-dollar question for the Fed, right? If inflation is really truly headed back to their 2% target, does that give them the green light to keep cutting interest rates? Because, lower rates would be like a shot in the arm for the economy and the stock market, making it cheaper for everyone to borrow and invest. But here's the thing. Even if we had a crystal ball for AI and inflation, the future is never, ever that simple. There are always these wild cards lurking on the horizon, things that can come out of nowhere and just completely upend even the smartest forecasts.
And here are just a few of what you might call the known unknowns for 2026. In the US, you've got the midterm elections and a huge Supreme Court decision on tariffs. Then you look abroad, and the Bank of Japan is making moves that could send shockwaves through the entire global financial system. And of course, there's always the risk of geopolitical tensions flaring up. I mean, any single one of these could set off a major bout of market volatility.
But it's not just about politics or geopolitics. Sometimes the biggest risks, well, they're born right inside the markets themselves.
Michael Leibowitz points to what's been happening with precious metals lately, how the prices have just gone vertical. He sees that as a major warning sign. When you see an asset move like that, it's often a sign of speculative fever taking over. And history tells us that when these things finally correct, the reversal can be, in his words, short, violent, and brutal. It's just a stark reminder of how fast the mood on Wall Street can change.
So what actually stops a crazy rally like that? Well, sometimes it's the folks in charge. And this analogy is just perfect. The party ends when the bartender refuses to serve any more punch. In market terms, that's when an exchange, like the CME, suddenly jacks up margin requirements. They're basically increasing the down payment you need to make a big leveraged bet. By making it way more expensive to play the game, they can stop a speculative frenzy dead in its tracks.
And this really brings us back to a simple but powerful idea, the law of averages. As Michael Leibowitz puts it, what are the odds of having 4 20% plus years in a row? They're not high. And he's right. You just can't defy gravity forever. At some point, things have to return to normal.
Okay, so after weighing the bull case, the bear case, and all those crazy wild cards, what does this all mean for you? What are the key things to keep in mind? Let's try to put together a little playbook for 2026.
All right, here's the bottom line. First, valuations are stretched. The market is priced for perfection, so there's not a lot of room for error. Second, AI is everything right now. It is this central narrative, acting as both the biggest reason for hope and the biggest source of fear. Third, don't forget about the K-shaped economy. That's where the top is doing great, but a lot of people are struggling. It means the big economic numbers might not be telling the whole story. And finally, just expect volatility. With so many potential triggers out there, you have to be ready for some sharp moves in the market.
So we come back to this. The experts are completely divided. And maybe that means the most important question for 2026 isn't trying to guess exactly what the market will do, because who really knows? Maybe the real question is, how are you going to prepare for and navigate what is almost guaranteed to be one heck of a ride?